Unemployment applications have ticked up for the first time in 3 weeks. 198,000 Americans applied for jobless benefits in the week ending March 25th. That's up 7,000 from the week before. And the latest data from the Bureau of Economic Analysis shows the fourth quarter U.S. GDP grew at an annual rate of 2.6%. That's slightly lower than the previous estimate of 2.7%. So let's bring in CBS News contributor Javier David to discuss this. He's also the managing editor for business and markets at Axios. Javier, what do the latest GDP and unemployment numbers tell us about the overall health of the U.S. economy?
So first jobless claims, we had it tick up a little bit. It's still below 200K, which is sort of a benchmark of what we consider to be kind of like a job market that's thawing. So while we have what I believe is like a labor demand that's cooling, it's not completely extinguished. So with jobless claims, we're still like within shouting distance of that 50-year low, believe it or not, even with all of the layoffs that we've seen over the last several weeks, which have really been contained to the tech sector. 187K, which is that watermark that we hit last year, that's still not that far off from where we are now. So what we have is a bottom line is this data series is still not really behaving like anything that's remotely close to sort of a recessionary indicator at this point. And growth, GDP, I'm sorry.
No, go ahead.
Just GDP also, it's showing that growth is still strong, but consumers starting to get tired. Each successive revision has seen consumer spending sort of get downgraded. And I think that's consistent with what we're seeing in real-time indicators that consumers, I think, are slowly but surely starting to close their wallets. Higher inflation, higher rates and borrowing costs are really starting to bite.
All right, so maybe this soft landing is not just, a pipe dream. Maybe it could happen.
For sure.
Yesterday, the NASDAQ 100 entered a bull market for the first time in 3 years. Explain what that means.
Yeah, tech stocks, we talk so much about tech companies laying off, but some of the things that we've discussed in this last several weeks and months is like, it kind of underscores how the issues that battered these companies in like late 2022 and earlier this year are really idiosyncratic, and they're kind of ephemeral because now, at least for now anyway, they're being helped by the drop in interest rates, which ironically is kind of tied to recession fears in the market, betting that the Fed is going to have to hit the pause button sooner rather than later. High rates are very, very important to technology stocks. The S&P is up roughly 4.9% as of yesterday's close. The NASDAQ composite is actually up more than 13%. A lot of these gains, it's kind of also in some ways a little deceptive because it's being led by some of the usual suspects in tech. Apple, Microsoft, Alphabet, all of those are up double digits. Meta and Tesla also have an absolutely spectacular rally. Meta, which is the parent company of Facebook, up nearly 70%. Elon Musk's company up nearly 60%. And investors really pleased that Facebook is slowly but surely phasing out this metaverse phase of its, which hasn't really worked out all that well.
It's a little awkward when you change the entire name of your company to Meta, and then you're like, I think we're going to look at the AI.
It's another one of those things. What Emery and I were just talking about, for all the reporters, including some of us here at CBS, we were joking about it that they're going to look back in 10 years, one of those retrospective pieces about like this time in 2023, and they're going to be like, and then this dude was talking about like the metaverse. And like, well, we know how that went. Yeah. So let's talk about.
As the Wall Street Journal wrote this week, the metaverse is turning into the meh.
You're right.
That's great. Let me ask you about. Yeah, that's awesome. Let me ask you about banking fears, which are easing now, as you know, since the collapse of Silicon Valley Bank. You pointed out tech stocks are rallying. So is it time for investors to be breathing a sigh of relief, or is it too soon?
Yeah, I mean, I think the biggest takeaway from the banking crisis that we've seen unfold over the last month or so is these issues are not systemic, but they are kind of problematic, as one analyst pointed out. Policymakers are going to continue to try and bolster confidence in this sector. They're going to try and continue to pump liquidity into the system. They don't want it to become systemic. But what we're seeing already and what we expect to happen is this is going to play a substantial role in cooling the economy, because a lot of the lending decisions that are handled by small and mid-sized banks, primarily commercial real estate, they're going to start to pull back the strings. And what we're going to see is a chill in office building, apartment building, which is ironically what we need. We need more apartments. We need cheaper apartments, because apartments as a category is sort of, at this point, one of the single biggest contributors to inflation, if not. The demand for apartments or affordable apartments is so dire, and we don't have enough units to sort of satisfy that. And because mortgage rates are so high, people are not leaving their apartments the way they used to. So they're continuing to rent. It's curtailing the amount of supply that we have in the market. And, you know, I guess the outgrowth of all of this is we're going to have fewer apartments when we really actually need them.
All right, which means up goes the price of rent.
That's right.
All right. Javier David, thank you very much.
Absolutely.